All right, today we are diving into a hidden giant of the financial world. It's a market that quietly shapes pretty much everything: our economy, our jobs, our investments, every single day. And you might not see it, but oh, you definitely feel its impact. We're talking, of course, about the bond market. So let me ask you a question. What market has that kind of power? It's not the stock market. You know, the one that gets all the flashy headlines on the nightly news? Nope. Its influence runs way, way deeper. It's kind of like the invisible force that holds up our entire global financial system.
The answer? It's the bond market. And to give you an idea of the sheer scale we're talking about, just look at this number. That's the US national debt, and that entire figure is financed almost exclusively by people buying and selling bonds. This staggering amount is really at the very heart of the story we're going to unravel today.
Look, while the stock market gets all the love and the headlines, the bond market is arguably way more important. Think of it like the foundation of a skyscraper. It's how governments fund everything from roads to healthcare, and it's how huge companies pay for their big projects. It's not glamorous, but it is the essential plumbing of the global economy.
So what is a bond anyway? It sounds super technical, I get it, but honestly, the core idea is about as simple as it gets. Imagine you want to launch a business, but you don't have the cash. What do? You borrow it. A bond is just a massive, formalized version of that exact same idea.
So if you remember only one thing from this, let it be this. A bond is just a loan. That's it. It's a fancy IOU. When you buy a bond, you are lending your money to someone, like the US government, and they promise, hey, we'll pay you back in full, and we'll even give you some extra interest payments along the way. It's really that straightforward. And here's how it all plays out, step by step. It all starts when the government realizes it's going to spend more money than it brings in from taxes. So to fill that gap, they hold auctions to sell bonds to investors. Those investors become the lenders, the government becomes the borrower, and it's on the hook to pay them back with interest. So at its core, you really just have two main players in this game. You have the issuer, that's the borrower who needs the cash, and you have the investor, that's the lender who provides the cash hoping for a return. And when we say investor, it's not just some Wall Street giant. It could be a pension fund, or it could literally be you. But wait, why does the government need to borrow so much money in the first place? Well, this quote right here just nails it. Almost every year, governments spend more than they collect. That gap, that shortfall, has a name: the budget deficit. And the only way to fill that hole is to borrow, which, you guessed it, means issuing more bonds. All right, quick vocab lesson, just so we're all speaking the same language. The principal is just the starting loan amount. The maturity, that's the day the loan is all paid back. The coupon is that fixed interest payment they promise you up front. And then there's the yield. Now this is where things get really, really dynamic. Okay, we've arrived at the single most important concept you need to understand about the bond market. It's the relationship between a bond's price and its yield. And the absolute best way to think about it is as a seesaw. When one side goes up, the other must come down. So check this out. That coupon payment we talked about, it's fixed. It's set in stone and never, ever changes. But the price of that bond, oh, that's changing all the time on the open market. So think about it. If you manage to buy a bond for cheap, for less than its face value, that fixed payment is now a bigger percentage of what you paid. That's a higher yield for you. And of course, the opposite is true. If you pay more for it, your yield goes down. So where does all this price-setting action happen? Well, it's kind of a two-part story. First, you've got the primary market. That's where new bonds are born at treasury auctions. But honestly, the real show, the real drama, is in the secondary market. This is where trillions of dollars in existing bonds get traded every single day. It's where the collective wisdom, or maybe fear, of investors sets the interest rate in real time. And this quote right here just says it all. You know, we talk about interest rates like some person in a dark room decides what they are. That's not how it works. Not at all. Market rates are simply the result of millions of buy and sell decisions made by investors all over the globe, all based on what they think is going to happen next with the economy. Okay, so that's the how. We've got the mechanics down. Now for the so what. How does all this Wall Street stuff actually ripple out and affect, the real world, our world? Well, the first and most direct impact is on the government itself. When bond yields rise, it just means that investors are demanding a higher interest rate for lending the government money. Plain and simple. That makes it more expensive for the government to borrow new money and to pay the interest on all the debt it already has.
And when I say costs, I mean the numbers are just astronomical. Get this. Right now, the U.S. government pays around $3 billion a day just in interest. So you can imagine when market rates tick up even a tiny little bit, that daily bill explodes, leaving less money for everything else we care about, like healthcare or education. All right, let's put on our investor hat for a second. You've got some money, and you have a fundamental choice to make. Do you put it in a super safe government bond with a guaranteed return, or do you roll the dice on the stock market for a potentially bigger payout? That government bond return is considered so reliable, they actually call it the risk-free rate, because the U.S. government defaulting is, well, it's almost unthinkable. And that brings us to this really important idea called the equity risk premium. It sounds complicated, but it's not. It's just the extra little bonus, the premium that you expect to get for being brave enough to buy a risky stock instead of that safe bond. It's basically your reward for taking a risk.
Okay, so here's the chain reaction. Follow me on this. Bond yields go up. That means the risk-free rate goes up. And all of a sudden, that extra bonus for owning stocks, the risk premium, it doesn't seem so great anymore, right? Investors start saying, hey, why am I messing around with risky stocks when I can get a sweet guaranteed return from a bond? And boom, they start selling stocks to buy bonds. And that big shift in money can slow down the whole economy. So let's connect all the dots and bring this right back to your wallet. Why should you care about this crazy invisible dance of prices and yields? Because that risk-free rate we just talked about, that becomes the starting point, the foundation for pretty much every loan you will ever take out. Your mortgage, your car loan, your student debt, it all starts there. So if you're going to take away just 3 things from all this, let them be these. 1, a bond is just a loan. Super simple. 2, that seesaw between price and yield is the engine that sets interest rates for all of us, and it affects how much it costs to borrow anything. And 3, because of all that, the bond market is kind of like a fortune teller for the economy, sending signals that ripple out everywhere. And all of this leaves us with one final, pretty heavy question. This whole system, the bond market, lets governments spend money they don't have today. But that IOU, it doesn't just vanish. The interest bill just gets bigger and bigger. So as that mountain of national debt keeps growing, who do you think is ultimately on the hook to pay for it all? I'll leave you with that. Thanks for tuning in.